Okay, let's keep going. So how many types of loans are there? Broadly speaking, there are two types of loan, amortized and interest only. Clearly the difference is in an amortized loan, your monthly payment, it goes towards interest and also brings down the principal. Whereas in case of interest only, you are just paying the interest, you're not touching the principal. Now you can well imagine that in case of an interest only payment, even if you make the payment for the next 10, 15, 20, 25 years, your principal remains unbudged. It doesn't go down because you haven't paid down the principal. Whereas in case of an amortized loan, you are making the payments down. You're paying down the principal on a monthly basis. Now, of course, since we are paying down the principal, the payments are much higher. So for amortized loan, depending upon how far you want to stretch your payment, you can amortize the loan over 15 years or over 30 years. Now, clearly, if you stretch it to 30 years, your monthly payments would be lower. But then again, you'll have interest that you'll be paying over a much larger period of time. And let's go ahead and take a quick look at some examples. So here on the screen, we have got two loan options, 1 and 2. And so we just came up with the fictitious amount of $250,000. And again, we have tried to keep it really simple so we can do an apple for apple comparison. We're not looking at the closing cost here. We're not looking at the points. Just a plain simple, it's a $250,000 loan, 3.5% amortized over 30 years. And we're comparing that with a loan of $250,000 at 3.25%, a little lower interest rate. And we amortize this one over 15 years. So let's go ahead and see what it means. It means based on the 30-year amortization, your monthly payments will be $1,123. And come over to the 15-year side, as we said earlier, if you're trying to condense the timeline with which to pay down the loan, then your monthly payments are much higher. So you're paying almost an extra 50% higher, $1,757 a month. Your payments are much higher. But by the time you are done with the loan, you have paid a total of $316,200. Whereas if you are paying it over 30 years, you would have paid $404,000 and $137 by the time you're done with all 30 years of payment, which means in this case, in case of loan option 1, you'll have paid a total interest of $154,000. Whereas in case of option 2, you'll have paid about $66,000 in interest. Now, clearly, and if anyone is looking at these two scenarios, these two options, given how much you are potentially saving in your interest payments, I mean, it's almost a no-brainer, right? That one should go for option 2 and not option 1. But what's the biggest difference between the two? Your monthly payment. Of course, we are saving on the interest, but the biggest difference is your monthly payment. $1,123 versus $1,757. Now, again, in the first case, you are responsible for $1,123. You can absolutely pay more. If there are some months of the year when you got some extra disposable income, you want to put that towards a loan. And in this presentation, we'll go over the dramatic details, changes that it could potentially do to your loan, and we'll talk about that as well. But clearly, you've got the option to do that. And if you do that, your principal goes down quicker, and you are able to pay off the loan earlier, and then you of course are able to reduce your interest. But the difference between the two options is in option 2, you are legally required to pay $1,757 a month, no matter what. Whether you have a job, whether you've got some cash flow situation, whether it's Christmas, whether there's a health issue, you cannot be behind on this. If you fall behind, it affects your credit. It has a dramatic impact on your credit. You really don't want that. It could you could get into foreclosure. All kind of financial ramifications will happen if you fall behind on these payments. So the commitment between the two is in case 1, even though we'll end up paying more in interest, but our commitment is lower, $1,123, whereas in case of loan option 2, the commitment is much higher, $1,757. Let's now compare these options with the third option, where we are paying interest only. So again, let's take a look at the scenario where we are paying it's $250,000 at a higher interest rate at 6%. And we are paying interest only. So this amortized, you can just ignore this line. The monthly payments would be $1,250. Now, based on this scenario, we can make the payment for as long as we want, but all we are doing is we're paying down the monthly payment, we're paying down the interest, and the principal does not go down. As you go down and take a look at this chart, this is the summary of the loan after 1 year, 2 years, 3, 4. Each row represents 1 year. So as you can see, in the first year, we have made a total of $15,000 in payment. Of the $15,000, the amount that went towards interest was $15,000. Nothing went towards the principal. You didn't pay any extra payment, and your loan balance is $250,000. Now compare this scenario with loan options 1 and 2. In case of loan option 1, remember where the monthly payment was $1,123. We paid $1,123 a month. That means in 12 payments, we paid $13,471. Of that $13,471, $8,674 went towards the interest. The remaining amount, $4,798, went towards the principal, which means that your loan actually went down from $250,000 to $245,202. Now, as you come down the list, this was year 1. If you go down to year 2, year 3, year 4, look at this column. The payments remain the same because it's a fixed interest rate, and the payments will remain the same. But look at this column, the interest, the amount of the division of this, how will this payment get divided between the interest and principal. Look at this, the interest goes down every month. It was $8,674. Then 8,503 for the second year, 8,326 for the third year, 8,043 for the second year, and keeps going down. Whereas the remaining amount, which is the portion that goes towards the principal, it goes up every year. Look at now in loan option number 2, which was amortized over 15 years. So the payments were much higher. Here, in this case, we are paying $13,471 in the whole of the first year. In this case, we are paying $21,080 in the whole of the first year. Of that, the portion that goes towards interest is $7,930. But look at this, the principal deduction was $13,150. And this amount continues to go up and until it's in 15 years, the loan is paid off. Your last payment is $5 that you paid in the 15th year, and your loan is paid off. Whereas in this case, you still have a balance of $157,000, and you still have 15 more years of payments that you need to complete. So this was, I hope you could understand now that these are the options. The options 1 and 2 are amortized over 30 years and 15 years. And option 3 is no interest. And the main difference obviously is your affordability, how much you're able to afford to pay down. So are these really just the 2 options for a loan?